How did historical bank frauds use checking accounts? Imagine a time when banks were less digital, and checks were the main way to pay and transfer money. Back then, clever criminals found ways to trick the system using checking accounts. These schemes often played on the fact that banks took some time to clear checks, creating opportunities for fraud. One common trick was check kiting. Criminals would open multiple bank accounts at different banks and write checks from one to another. They would deposit a check into one account and then quickly write a check from the second account to the first. Because of the float period, which is the time it takes for a check to clear, they could make it look like they had more money than they really did. This allowed them to withdraw cash or make purchases before the bank realized the checks were fake or bounced. Another method involved counterfeit checks. Fraudsters used special printing machines to create fake checks that looked just like real ones. These checks often had magnetic ink and logos that mimicked genuine business checks. They would pass these fake checks at stores or banks, tricking them into giving out money or goods. Sometimes, criminals stole checks directly from the mail or from people's homes. Once they had the checks, they could cash them or sell them on the black market. Mail theft was a big problem because checks were often sent through the postal system, which was less secure back then. Forgery was also a common tactic. Thieves would steal checks and change the payee's name or the amount written on the check. They might forge the account holder's signature to cash the check or make it look legitimate. This type of fraud depended on the criminal's ability to convincingly alter the check without getting caught. Identity theft was another way criminals used checking accounts to commit fraud. They would steal personal information from checks, such as names, addresses, and bank account numbers. With this information, they could open new accounts or create fake checks, then use these to steal money or make unauthorized purchases. Banks and credit unions learned from these schemes and started to improve security. They introduced better verification processes, encouraged customers to destroy unused checks, and advised them to notify the bank when closing accounts. Advanced technology like electronic check verification and fraud detection systems also helped catch suspicious activity early. Understanding these past tricks helps us appreciate the importance of keeping our checks and personal information safe today.